Welcome back to our channel. In today's breaking news, we delve into the latest developments from Russia as it battles the economic consequences of its involvement in the Ukrainian conflict. Facing a weakening ruble and mounting expenditures of the war effort, the Russian government has taken a bold and unexpected step to tackle the surging inflation. Moscow has decided to raise interest rates significantly in a bid to cool down its wartime economy. This move is aimed at curbing inflation and stabilizing the nation's financial situation amid escalating tensions. Join us as we analyze the potential implications and ramifications of this daring economic measure. Don't forget to like, subscribe, and hit the notification bell to stay informed of the latest global economic updates. In response to the complex economic challenges arising from the ongoing conflict in Ukraine and its spillover effects on Russia's financial landscape, the Russian government has embarked on a critical mission to combat inflation and stabilize the national economy. Amid growing apprehension regarding the mounting costs of the war effort and the consequent depreciation of the Russian ruble, the central bank has taken bold and unexpected action. Implementing a decisive maneuver, the bank raised its benchmark interest rates by an astonishing full percentage point, propelling it from 7.5% to 8.5%. This momentous rate hike represents the most substantial increase witnessed in over a year, underscoring the severity of the inflationary threat the nation faces. However, this move is not an isolated measure. Instead, it serves as an ominous warning to financial markets and stakeholders, indicating the potential for further rate adjustments as the situation evolves. The decision to raise interest rates is a calculated response to the complex web of economic challenges posed by the ongoing Ukrainian conflict. Escalating military expenditures have strained Russia's fiscal resources, heightening concerns over inflation spiraling out of control. Furthermore, the depreciation of the Russian ruble, partly influenced by geopolitical uncertainties and external sanctions, has exacerbated inflationary pressures by driving up import costs and reducing purchasing power for essential goods and services. In this context, the central bank's move to tighten monetary policies aims to curb inflation and restore confidence in the nation's financial stability. However, the cautionary note about potential future rate hikes indicates that the government acknowledges the need for ongoing vigilance and flexibility in their economic approach, as the situation remains fluid and unpredictable. The unexpected decision reflects the central bank's growing apprehension about inflation and the overall state of the economy, according to Robert Kahn, head of the geoeconomics team at the Eurasia Group. The ongoing war is causing increasing disruptions to economic activity and exerting upward pressure on inflationary trends. While initial hopes that sanctions would cripple the Russian economy have diminished, the war's effects continue to reverberate through the nation, resulting in heightened military spending, labor shortages, and a progressively deteriorating trade balance, as noted by experts. In her announcement of the interest rate increase, Elvira Nabiullina, the central bank governor, indirectly acknowledged the war's impacts by referring to challenges faced by companies in expanding production due to labor shortages. As demand consistently outpaces supply, prices inevitably rise, leading to inflation pressures. The central bank's forecast for inflation this year is projected to be in the range of 5% to 6.5%, which is lower than the previous year but still above their annual target of 4%. Various factors are contributing to this situation, with one significant factor being the considerable weakening of the ruble against other currencies since the anti-government rebellion led by Yevgeny Prigozhin's Wagner Group in late June. The exchange rate has risen to over 90 rubles to the US dollar, from about 83, resulting in higher import costs for Russia due to its substantial reliance on foreign goods. This poses a particular challenge to the country as President Vladimir V. Putin has linked many social spending programs to the inflation rate. Ensuring pensions and other payments are kept in line with inflation has been a key aspect of Putin's policies, but the current economic circumstances have strained their ability to afford such commitments. Charles Litchfield, Deputy Director of the Atlantic Council's Geoeconomic Center, expressed concerns that the government might face difficulties in meeting these social obligations given the presently high inflation rate. The extent of the Russian government's military spending remains shrouded in uncertainty, encompassing a wide array of expenses ranging from the acquisition of new armaments to higher salary payments for an ever-expanding force of newly recruited soldiers. With 1/3 of the government's spending allocated to defense and security-related matters now kept under wraps and classified, the true scale of these expenditures has become a matter of speculation. However, there is no denying that such spending has been burgeoning. Under President Vladimir Putin's administration, the government has channeled massive sums of money into the production of advanced weapons and materials, a clear reflection of its long-term commitment to sustaining the conflict in Ukraine. Simultaneously, the administration has shown the country's citizens, including those residing in occupied regions of Ukraine, with a plethora of subsidies, notably including subsidized mortgages and various other social payouts. Although these extensive financial support measures have been intended to bolster the nation's welfare, an unintended consequence has arisen. Salary and compensation payments to Russian fighters deployed in Ukraine have led to an inflationary surge, driving up average wages. This in turn has presented significant challenges for numerous civilian industries in their efforts to attract and retain skilled workers. The multifaceted economic landscape that has emerged as a result of Russia's wartime spending spree and social support programs has brought about a delicate balancing act for the government. On one hand, there's the urgent demand to bolster military capabilities and sustain the conflict in Ukraine, while on the other hand, the administration must ensure that the economic implications, such as inflation and labor shortages, are carefully managed. As policymakers navigate these complex economic dynamics, the implications for Russia's economic stability and growth trajectory remain of paramount importance. The labor shortages in Russia have been exacerbated by a substantial number of working-age individuals leaving the country either to protest against the war or to evade mobilization. Additionally, tens of thousands of lives have been lost on the battlefield of Ukraine, according to some estimates, further impacting the workforce and productivity. Amidst the significant expenditures on the war effort, Russia's earnings for energy exports have diminished, though they remain noteworthy. In June, the central bank reported the first negative trade balance since 2020, highlighting the challenges faced in balancing the nation's financial position. Furthermore, the war and its associated economic uncertainties have prompted Russia to transfer approximately $40 billion in cash holdings abroad since the conflict began in February 2022. While the government initially imposed strict controls on foreign currency movement out of the country, these restrictions have gradually been relaxed over time. The current approach of the Russian government, wherein it is spending considerably more money than it is earning, raises concerns about the potential for escalating inflation. Charles Litchfield warns that the government's fear of losing control over inflation is justified as it continues to pump money into the economy. Ms. Nabiulina's emphasis on mitigating the overheating risk reflects the government's commitment to responsible economic management. Presenting excessive exuberance and potential bubbles in certain sectors or asset classes becomes paramount. To achieve this, the central bank may resort to employing various macroeconomic tools, including adjustments on interest rates, reserve requirements, and other monetary measures. The challenge lies in calibrating these interventions with precision to ensure a balanced and sustainable growth trajectory for the Russian economy. In conclusion, Russia's central bank projects a growth rate of up to 2.5% for the year, reflecting the possibility of the economy returning to pre-crisis levels of activity amid the lingering repercussions of the Ukrainian invasion. Despite this optimistic outlook, the cautionary stance of Ms. Nabiulina highlights the importance of guarding against overheating risks. Striking a delicate balance between fostering growth and preventing unsustainable economic exuberance becomes a crucial task, necessitating the judicious application of monetary policies and a keen awareness of external factors that could impact the nation's economic trajectory. In navigating this complex landscape, the government aims to chart a course towards resilient and stable growth, fostering an environment of sustained prosperity for the country. And that's it for today, guys. Thanks for watching, and we'll see you in the next one.